What if I told you there was a form of investment that allows you to diversify your portfolio and have your funds professionally managed by fund managers? What if I said that this form of investment is available to you right this second? Well, as you probably saw from the title of this video, I'm talking about mutual funds. In the next few minutes, you will learn what mutual funds are and some of the amazing benefits that they offer. Coming up.
Listen.
Hey, this is Carlos with Influential Finance, and on this channel I make weekly videos to help you improve your personal finances. So if you're new here, consider subscribing. Today, we're talking about mutual funds. Now, before we jump into mutual funds, make sure to first watch one of my previous videos where I spoke about individual stocks and the stock market overall. That video will help you better understand mutual funds as well. I'll leave a link to that video in the description of this video below. With that said, let's jump into it. Let's start off with going over the main question for this video. What are mutual funds? Mutual funds are investment funds managed by professional managers who allocate the funds received from you, the investor, into stocks, bonds, and other forms of investment. Think of buying a big basket with many different types of investments. You can buy one share of a mutual fund for as low as $10 or even less in some cases, and your money will get invested across many companies and many investment types. Some mutual funds can focus on specific industries such as technology, healthcare, or even retail, while other mutual funds can focus on different size companies such as small cap, mid cap, or large cap mutual funds. So how do you make money from mutual funds? You may remember from one of my previous videos that there are two ways to make money in the stock market. These two remain the same for mutual funds: appreciation and dividends. Appreciation is when the value of a mutual fund you invest in goes up. On the other hand, dividends are periodic payments that companies make to their investors. Companies make these periodic payments to give their investors a portion of their company profits. Let's briefly go over the two main benefits on why you should consider investing in a mutual fund. One of the main benefits of investing in mutual funds is diversification. Diversification means that you are spreading your investments across several different industries and several investment types. Basically, don't keep all your eggs in one basket. Diversifying your investment portfolio will greatly reduce the risk that you take when investing in the stock market. To give you an example of this, if I have 100% of my money invested in one company and that one company suddenly goes bankrupt, that means I just lost all my money. On the other hand, if I have my money in a mutual fund and that mutual fund spreads my investment among 50 companies, one company doing poorly will have very little effect on the overall value of my investment. Another benefit of investing in mutual funds is that some mutual funds can have your money managed by professional fund managers. In actively managed mutual funds, there is a team of professional investors that will invest your money to try to outperform the overall stock market. Now, keep in mind that if that doesn't make a lot of sense to you, in a few seconds we will go over what the difference is between actively managed and passively managed mutual funds. One thing to keep in mind is that there have been many studies done which have found that fund managers do not beat the market over a long period of time. They may beat the market 1 or 2 years, but it is highly unlikely that a fund manager will be able to beat the market over a 10-year period or more. Highly unlikely, but not impossible. A few seconds ago, I mentioned that some mutual funds can be managed by fund managers. Let's talk about the difference between actively managed and passively managed mutual funds. Actively managed mutual funds are mutual funds where a team of investors buy and sell the shares in order to try to beat the stock market. Although this may sound like a great thing to have, these fund managers are not cheap. They will take a percentage of your investment as a payment for their services, whether they make you money or not. Passively managed mutual funds are funds that, as the name suggests, are not actively being traded. These funds tend to follow a specific stock market index, such as the S&P 500. I won't go into much detail about what a stock market index is. If you'd like to learn more about what a stock market index is, I'll leave a video linked in the YouTube card above. Since passively managed mutual funds don't require investors to be actively trading within the fund, the fees for these tend to be significantly lower. Some are even free. Yes, you heard that right, free. Now, let's go over some of the bad news. You guessed it, it's the F word. fees. Let's briefly go over some of the possible fees you can encounter when looking at mutual funds. First, you have management fees. Management fees are fees charged by the fund managers in order to cover the cost of managing the mutual funds. Like I mentioned previously, these will fluctuate depending on whether a fund is actively managed or passively managed. Next, you have transaction fees. This is a fixed fee that you pay to buy into a mutual fund. One thing to note is that many financial institutions are getting rid of transaction fees and letting you buy shares without any transaction fees at all. And lastly, we have what's called a sales load. Without getting too technical here, a sales load is simply a fee to either buy or sell shares in a mutual fund. If it's a fee to buy into the mutual fund, it will be called a front-end load. And if it's a fee to sell shares of a mutual fund, it will be called a back-end load. Transaction fees and sales load are very similar. What differentiates them is that a transaction fee is a set amount, like $10 for example, and sales load tends to be a percentage of your overall investment, generally between 3 to 6%. All of the information you need about a specific mutual fund will be included in a document called a prospectus. This document should be accessible to you before you make any investing decisions. As always, make sure that you speak with a financial advisor before making any investment decisions. And always remember that personal finance is personal. So don't make any investment decisions based off what people around you are doing. Make the decision that best fits your investing goals. That pretty much wraps it up for this video, but if you'd like to watch my intro video about investing in the stock market, I'll leave that video linked on the top right corner of your screen, right up there. Make sure to click on my face right here to subscribe, and if you'd like to continue watching videos on my channel, I'll leave another video linked right over there. That's been it. I'll see you in the next one.